Good afternoon. This is Kevin Camden with Camden Law Office, and I'm here with my colleague Isaac Kim. And we're going to talk about some tax avoidance strategies that you may not have heard of over a course of a few videos. And today we're going to talk about an IIS. And with that, I will turn it over to Isaac.
All right, Kevin, thank you very much for having me. It's great to be here, Kevin, and I hope we can share some really interesting information today on how people can mitigate capital gains tax. And so if it's okay, I'll go ahead and I'll share my screen. Real quick, I'm a financial advisor, and one of the ways that I help people is I help people reduce capital gains tax. Today, we'll talk about the intermediated installment sale, or the IIS trust. I will refer to it as an IIS. We can use this strategy to mitigate capital gains tax when you're selling a business, when you're selling investment real estate, but this will also work for the sale of your residence. So if you're selling your residence and you like to mitigate capital gains tax, this will also work.
And that's a significant point, because a lot of our investor clients who are familiar with 1031 are always looking for alternatives or options on the way to avoid or mitigate taxes on the sale of a personal residence. So this is another nice arrow to have in the quiver for purposes of tax avoidance.
Absolutely. This will absolutely work. And I'm working with several people right now who are either selling their residence or they're selling their parents' residence. The parents are downsizing. And so we're going to help them defer the payment of capital gains tax. All right, so the goal here is to defer the payment of capital gains tax. So what I like to do real quick is just cover, why do you want to defer paying capital gains tax? What's the benefit of doing that? So there are two main benefits. Benefit number one is that there's more money available to invest on behalf of the taxpayer. Let's say you have a client and let's say they're selling a business for $10 million. I'm just choosing a round number. Let's say they have to pay 30% combined capital gains tax, state and federal. They would have to pay $3 million, and after paying the $3 million, they would have $7 million left over. With the IIS, there's no capital gains tax due right now because we're going to help the client defer paying it for 10, 20, or 30 years. It's up to the client to decide when they want to realize these capital gains and pay the taxes. So what that means is, because they're not going to pay the taxes now, we can keep the full $10 million and invest $10 million on behalf of the client, rather than them having $7 million left over after paying capital gains tax. So the simple question is, would you benefit from investing $10 million instead of $7 million? I think most people can figure out the math on that one. It's pretty simple. There's no interest cost to use that $3 million. We're just taking advantage of the Internal Revenue Tax Code. The second reason why you want to defer paying capital gains tax is when you do pay the IRS, you will pay them with depreciated dollars. $1 today is worth more than $1 20 years from now. So why not keep the money and pay the IRS 20 years from now in dollars that are worth less than they are today? So Kevin, those are the two main reasons that you might want to defer paying capital gains tax. Any question here?
No, so I'm following along. Point number two also makes sense if you expect that the tax rates are going to continue to increase. And I think we'd all agree that they're going to increase over time. So why not take the appreciation to hedge against what the tax rate increase could be over that same period of time?
Right. And, what I tell people is, because people, I say, look, tax rates are going to go higher, and they might, but you never know what's going to happen with politics and whether or not it will go up or not, because right now, changing the tax code, I think it's next to impossible. But
well, I think we could all agree that the tax rates are not going to decrease. Whether they increase is another question, but they're not going to decrease, which supports your position relative to the depreciation even more.
Absolutely. Okay, so with that, let's just go ahead and let's go through the IIS really quickly, and so everyone can understand the strategy. It's actually pretty simple. Okay, so let's say you have a client and let's say they're selling their residence. What they're going to do is, your client will find a real estate agent. The real estate agent will list the property, and the real estate agent will go out and find a buyer. When they agree on a sales price, the buyer and seller, that's when we're going to hop into action. What we'll do at that point is we will hire a tax attorney, and that tax attorney will create the IIS trust. Now, this trust is necessary to execute this strategy. All right, so
where
now
is the
the trust
trust
is
based, Isaac? Is it where the real estate is based, or where the seller is based or has residence?
Actually, it's a Nevada trust. It's
Okay.
always a Nevada trust. And we choose Nevada because the asset protection laws are very strong and the state income tax is zero. So we want to go to a low tax jurisdiction.
Okay.
All right, so we have this trust, this Nevada trust. What's going to happen is the seller is going to sell the asset to the trust. And in turn, the seller is going to get a promissory note back. Now, let's assume this is a $10 million transaction. It can be smaller. I'm just using 10 million as a nice round number. What would happen is the seller, if it were a $10 million transaction, they would get a promissory note for $10 million. Now, I'll tell you more about the promissory note in a second. Let me just go through the transaction real quickly so everyone understands how this will work. So the seller's going to get a promissory note, which I'll explain in greater detail in a minute. But the reason we use a promissory note here is that the promissory note allows us to defer paying capital gains tax. Right here, if the seller takes cash, they have to pay capital gains tax to the IRS. But because in this situation, they're getting a promissory note, we can defer the payment of capital gains tax.
So
So the
to
seller,
draw a comparison, let me interrupt for 1 second. Draw a comparison to 1031, which a lot more people may be familiar with. The IIS trust acts as a qualified intermediary. The difference is, unlike the short time period under a 1031 where you've got to identify and purchase, in this circumstance, the trust can exist for up to 30 years, correct?
Yes, it can. So yeah, absolutely. Great explanation. Okay, so now the trust, they own the asset, right? They bought it with a promissory note. The trust is going to turn around and they're going to sell that asset to the buyer for the agreed upon price of $10 million. I think we agreed on $10 million as the sale price. So the seller got a promissory note for 10 million and the trust, they sold it to the buyer for 10 million. The buyer brings $10 million to close. The buyer's out of the picture. We don't need to worry about them anymore. And the trustee now has $10 million. Now, one quick point, this is an installment sale. In most installment sales, the seller has to do some kind of financing. In this strategy, there's no seller financing. The buyer has to bring the entire amount to close. So $10 million goes to the trust and the $10 million is put into the trust account. As long as the $10 million stays in the trust account, the seller doesn't have to pay capital gains tax. We can defer it. One last thing about the trust account. The $10 million in the trust account, that is legally the collateral that backs the promissory note that the seller received. So the promissory note is not a worthless piece of paper. It's legally backed by these assets. Okay, so now the seller has a promissory note. We said it's for $10 million. That promissory note typically has a 10-year maturity, and then it will have a stated rate of interest. Let's say that stated rate of interest is 6%. That means the seller will get 6% interest a year on $10 million. 6% on $10 million is $600,000 a year of interest income, and that would be taxed as ordinary income every year that they get it. Now, if the seller had paid $3 million in capital gains tax and they had $7 million left over, 6% of $7 million is $420,000. So obviously $600,000 is considerably more than what you would get with $7 million. Okay, so the seller has this promissory note and they're going to get interest every single year. They will pay taxes on that ordinary income. The note typically has a maturity of 10 years. At the end of 10 years, the note matures. When the note matures, the seller can either extend the note, which happens a lot. The seller can cash in the entire $10 million, in which case they would get the $10 million and then they would pay capital gains tax, or they can extend part of the note and cash in part of the note. It's totally up to the seller and it's very flexible. The
One of
last thing that I want to say,
I know
sure.
somebody would have is, what's the security here? Is the note recorded against the property?
No, the note is recorded only against the assets inside the trust here, the $10 million.
Okay, so the security interest is the trust assets. Okay.
Yes, absolutely. Yeah, the trust assets. So one question that I get quite often is, okay, the seller has a promissory note for $10 million. What if in year two, the client needs $500,000 or they need $1 million? Can they get that money? And the answer is yes, they can. Now, let me explain it this way. The seller has a promissory note for 10 years and $10 million. There is nothing in the promissory note that says the seller can force early payment of that promissory note. But the seller can always go to the trust and they can ask the trust, hey, can you prepay $1 million or $500,000? The trust is under no obligation to pay that money, but if you ask, I think they would favorably consider that request, and so the seller could get access to the assets. One other thing that I'll say, and then I think we can wind it up, Kevin, is people always ask me, Isaac, why do you talk about this strategy? Because you're a financial advisor, you manage money, you help people retire. Well, the reason I talk about this is the money in the trust account has to be managed by a third party. It cannot be managed by the seller. The IRS will not allow it. So I'm a financial advisor and I would like to be the fiduciary who is managing the money inside the trust account. And that's about it, Kevin. That's it at a high level, not that difficult. And, you know, as I mentioned, we bring in a tax attorney to draft this trust. And so that tax attorney is always there to give the seller tax advice if they need any tax advice.
Right. Excellent. How many of these are you currently acting as a fiduciary for?
A little over 5, but the partner that I have, Dunham Trust, I mean, they've done over 100. So
Okay.
they're extremely experienced in this. And, you know, Dunham Trust, they act as a trustee here. And so you have 2 different fiduciaries looking out for the seller, because the trustee, which is Dunham Trust, and, you know, I'm the fiduciary managing the money here. We're independent parties and we're both looking out for the seller's best interest.
Understood. Well, Isaac, this is interesting. Like I said, it's another tool for investor clients, although not necessarily limited to investors, but I think it's very appealing in that regard. And the next time our next installment, I should say, we're going to look at a DST or a Delaware statutory trust, which more and more people are hearing.
There you go.
And I look forward to hearing you explain that.
All right, sounds good. Kevin, thank you very much for your time. I appreciate it. And everyone who's watching this, I hope you'll be here next time when we talk about Delaware statutory trusts.